All right. Well, it looks like our numbers are topping out here. So we'll begin. Good morning, everyone. I'm Brad Long, Managing Partner and Chief Investment Officer here at Fiducian Advisors. Thanks for joining us for our Q3 WebEx. So as a quick reminder, we hold four of these a year. Two of them are more focused on outlook. So, what we said was going to happen and what we think is going to happen in the coming year. And two of these are more focused kind of current trends, up to date, what's happening. And this is the latter. So we're going to talk a little bit about what happened over the quarter, what's happened over the year, with somewhat of a framework of call it what, why, and how. So what happened, why is it happening, and how does it influence your portfolio? As a reminder as well, we've got 30 minutes on the clock, so we'll try to stick to that as well as we can, or we will stick to that. And if you have questions, please feel free to ask them throughout. We can see them in the chat queue, so feel free to put them in as you think of them, or obviously we're going to leave about 10 minutes at the end specifically for questions. So today, not a new face, a familiar face here. I have Rob Lowry joining us. He's an associate research director on our team and heads our investment grade fixed income group. And between the two of us, we're going to give you a tour of the capital markets and go through most recent trends and things that are going on. So Rob, why don't you kick us off on markets and what's happening?
Great. Thanks, Brad. Q3 was a tough quarter for most asset classes. You can see all the circles in negative territory for the most part. And, the key driver of that was a Fed pause in September and that mentality of a potentially higher for longer interest rate environment. On the fixed income side, rising rates negatively impact bond prices, that inverse relationship. So you saw falling returns there. On the standout being high yield, credit, and continues to do well, and we'll unpack that a little bit more later on. But fundamentals in the investment grade and corporate space remain strong, and high yield, in particular, a little bit lower sensitivity to interest rates, being lower duration, and actually eked out a positive return there. On the equity side, again, higher interest rates, we saw equity valuations come in a little bit, especially in the higher growth areas of the market and those higher PE sectors. And then on the non-US side, international developed struggled a bit as an EM outperformed modestly compared to developed countries. The standout bright spot for the quarter, commodities being up almost 5%, driven on the back of higher energy prices, in particular oil. OPEC continues to have constrained supply and push oil prices higher there. But let's dive deeper a little bit into kind of on the equity side and some country performance. If we flip to the next slide, Brad. Countries were negative across the board, but we continue to see some diverging performance throughout. So a couple of standouts here, Germany and France. The Eurozone continues to struggle. Economic growth is weak there. Germany's had multiple quarters of negative GDP growth, a lot of that being driving that negative almost 8% return for the quarter. But on the flip side, we're seeing some positive momentum in select EM countries. India, in particular, has had really strong growth, greater than 5% GDP growth over the last few quarters. They've implemented a huge spending package on infrastructure that has been a tailwind for them. And then on the flip side, China continues to be a standout on the negative side year to date and for the quarter as well. The economy continues to struggle as they reopen from COVID restrictions, and there's ongoing concern about the real estate market and the debt levels that are compounding there. But overall, on a year-to-date basis, despite the poor quarter for Q3, equity markets generally have performed well.
So shifting that into valuation here, looking here at the United States, so this is the forward price to earnings, a very common valuation metric. The higher the figure, the less attractive. The lower the figure, the better. You can see we sit here at about 18 times forward earnings, relative to long-term averages, long-term about 16%. So, we're one standard deviation above, from a valuation perspective. So market valuations are full, but not extraordinarily full, not as high as they were, even pre the drawdown in 2022, and certainly not as high as they were before COVID. The primary thing that's driving that is, markets have been up. Obviously, Q3 was down, but in aggregate, markets have been up year to date, and really the rally since October 14th of last year. So prices are up, but earnings have been largely falling. Obviously, somewhat company and sector dependent, but in aggregate, earnings have been falling, and so the difference is multiples. Investors on the backs of lower inflation, both prints and expectations on the back that the Fed might begin stopping or slowing its rate hike policy. That has put a lot of vigor into investors, and they've been willing to pay higher prices. Now we know a lot of this has been driven by a handful of stocks in the U.S. I think the new dubbed term is the Mag 7, but you could call it the top five. That's the Apple, I guess the artist formerly known as Facebook, now known as Meta. Amazon, Nvidia has been a star player here for the S&P 500. And so, many of those securities have really pushed both the aggregate index up year to date and valuations up. Now, comparing that to its smaller brethren here in the United States, so the Russell 2000, that's small cap US stocks, trading at, call it average valuations here from a forward price to earnings basis. Now, the small cap index itself is a fairly unique index. It has a lot of non-earning businesses, so public companies that after they sell products, they create revenue, but then after all their expenses, they don't actually earn a positive or a consistent positive earnings. And so 34% of that index is actually constructed of non-earning businesses. If you back those out, these statistics look even better from a relative valuation perspective. And frankly, you've seen a lot of the fundamental managers we employ in that space take advantage of those relative valuations. Now, also, if you look at this from a style box perspective, right? So value, core, and growth, and large, mid, and small, the bookends of this are somewhat what you would expect. Large growth, which has been the belle of the ball almost for the last 15 years, but certainly year to date with the names that I just mentioned, those large cap growth is trading at about a 30% premium to its 20-year forward PE. Now, the bookend of that is the opposite. Coincidentally, in the opposite corner of the style box is small value. Small value is trading at a 16% discount relative to its long-term valuation. Does that mean that in 2024, large growth will underperform and small value will outperform? Absolutely not. But if you were to say, what is the one thing that's important if you could choose one thing, what's one thing that's extremely important over the long term in deriving portfolio allocation and decisions? What we pay for an investment matters, right? So valuation matters over the short term. And you can certainly see we have quite a bit of valuation dispersion here, both year to date, but just in aggregate. Moving our gaze outside of the United States here, we also see similar discounts and windows and somewhat dispersion across developed, emerging. Rob just mentioned Germany and France, two large economies in the EFI index that are pushing those valuations down here, now trading almost one standard deviation below historical averages and at 14 times. Now, 14 times is certainly much lower than 18 or 19 times here in the US. But I think it's also fair to say that many investors should know there's usually a pretty consistent higher multiple in the US, and that's based just on market construction. The US has a lot more technology and healthcare, and so it usually commands a higher multiple. But on a relative basis, and even to its own history, developed international does look attractive. And we talked a lot about that in our mid-year outlook. Now, in emerging markets, we talked about some of the underlying trends here. Obviously, the largest single country and economy in that index has been struggling, and that's China. And we spent, again, a lot more time last quarter unpacking China and its opportunity set. But in aggregate, emerging markets look about kind of average from a valuation perspective. And that's on the backs of some of the other countries and positions that have been doing well. India and Modi's policies to grow, a lot of economic growth. And they've been trying to really build themselves as kind of a belt and suspenders, almost like a China policy in growing and positioning across geopolitics and economics. Brazil is another standout. So there's a number of countries that have done quite well. So, as we look forward here from, where we stand now into 2024, again, long-term valuations matter quite a bit in asset allocation. In the short term, I don't want to say they're indifferent. They just, it's not as predictive in the short term. So as we start to talk about 2024 and our market updates, some of these figures and relative valuations will make an impact. And I think, in the coming slides here too, on the fixed income side, that's also going to make a pretty large difference in, the coming opportunity set that we have in front of us.
All right, let's take a little bit deeper look on the fixed income side and what was driving that poor performance. You can see that on the right-hand side of the screen is just the U.S. yield curve, and that dark blue line being the end of the third quarter and the light blue line being the end of the second quarter. You can just see the huge shift up in interest rates on the long end of the curve, that 10 to 30-year part, almost 90 basis points on the quarter alone. Now, what was driving that? At a high level, maybe the talk of Fed being higher for longer and that pause in interest rates shifted some market expectations up a bit. But there's also a host of other reasons we think driving that longer end of the curve up. One being, if we remember and go back to the beginning of the year, just that the most anticipated, right, recession. Everyone thought that we were going to have a recession in 2023. It hasn't played out yet. So there may be some repricing as the economic data comes in a little bit stronger than expected. Treasury yields have pushed up a bit. Other areas that may be driving that, just the growing deficit in the US and the increased issuance in Treasury, right? More supply would push yields higher with less demand. There's also been a lot of reduced foreign demand abroad, just the global higher interest rate environment, right? When German yields were negative in the past years and now they're positive, investors don't have to look necessarily to the US for getting that high quality yield. And then other buyers such as China just not buying as much treasuries. So some waning demand abroad. And then just buyers holding back generally, right? There's just been a lot of interest rate volatility over the last year. And it's very hard to time when the top will be or when the bottom will be, but investors sitting on the sideline, quote unquote, waiting to get back in, and maybe they missed the top but they're willing to give up some of that, 10, 20 basis points of yield if needed. While the rate environment has looked pretty weak over the quarter, the credit environment has actually been pretty strong. Credit spreads volatility this year has been really low. Spreads being the amount you're compensated above treasuries for that credit risk on the corporate bonds. They're right about at 10-year average levels for investment grade. If we look at the bottom, investment grade spreads sit at 121 basis points. The 10-year average right around 124. And then the same on the high yield side, just under the 10-year average, 394 to 428. But you can see well below that 20-year average. So, fundamentals in the corporate space look fairly strong and have been resilient. Corporations have been able to term out debt over the last few years at really low interest rates. So, extending duration or extending their debt at quote unquote zero interest rates makes it a much easier debt service down the road.
So transitioning there, I would say, well, Rob, I'm just thinking about those comments. The irony in the fact that corporate America, understood the remit and extended their liabilities when banks actually screwed that one up in the first quarter. We saw a banking crisis, but neither here nor there. Now, speaking of resilience, so as we look at spreads are certainly indicating that the economy is strong. We're not anticipating rising defaults. Yet, as Rob noted, coming into this year, call it the street, the prognosticators, economists, there was almost a hubris about the known quantity of a recession. Yet here we are, and recession has not, reared its ugly head. We've talked about this quite a bit, right? So last quarter we talked about, kind of the balance sheet side of consumers. So we talked about credit card debt balances, right? Over $1 trillion with the highest revolving credit line we've seen in multiple decades. We've talked about leading economic indicators, the inverted yield curve, kind of the farmer's almanac, if you will, indicator of, air quotes, reliable indicator of recession. Even though it tends to indicate, 12 of the last 10 recessions, right? It's a little jumpy or a little too predictive. So one of the things, or one of the narratives that's been coming up is more this, call it consumer wall, right? If you think about the United States GDP, the majority of GDP is produced by spending. You and I going out and buying goods or getting on an airplane or, consuming, items. Well, the notion that the consumer, right, has been Fading or weakening is one that's been this growing sense of worry across economists and market participants alike. So we have two charts here that are, the first thing I'd notice, these are estimates, right? This data is very hard to get in a precise way. But these are estimates of this notion of the consumer balance sheet is weakening. So the first one we're going to put up here is a chart from the Fed. So this is the Federal Reserve of San Francisco on the personal savings rate. And you can see, pretty steady Eddie until we hit the pandemic, and you see this massive wall of savings. And what was that? That was stimulus, right? So you see both of these, kind of an EKG up and down, and then an EKG up and down. And those are both stimulative efforts to try to keep us out of the manufactured recession that we were creating as we were, in this shelter-in-place economy. Then you see this dip well below this, blue line here indicating we're off trend. Another version of this is JP Morgan. Ironically, we put this in here. You can tell this is quite literally a screenshot from JP Morgan's deck. They actually have three different departments that have three different views on this version of savings: their economics department, private bank, and their investment bank, all showing, kind of different time periods of magnitude of consumer savings. Now, the one thing that remains consistent across all of these is the trend. The trend is downward. Now, there's disagreement on the time in which consumers might run out of capital and then therefore have to tighten their belts, right? You can't overspend for too long. Eventually, you have to stop spending or slow spending. So the question remains kind of out there as regards to time and magnitude, but the trend I think is fairly clear. And that's where we get back to this idea of, we've talked about the recession red herring. Even if you could time a recession, you would mistime markets. We also talk about recession is not prediction, but preparation. Like, recessions happen. They are a normal part of economic expansion and contraction. And so we shouldn't try to predict precisely will it happen in Q1 of 2024 or happen in 2026. We don't know, right? But we take the probabilities and the context around that, and then we build portfolios that are resilient in light of what may come. And we'll talk a little bit more about, building that resiliency and maybe a little bit of the tea leaves into 2024 when we start to talk about fixed income, the opportunities that provides there, especially relative, to the U.S. market. So the Fed is not unaware of this information. They're very well of the current state of the consumer and potential concerns, but by all intents and purposes, their number one priority still remains inflation. Now, they've done a lot of work, and inflation has tamed pretty considerably. This is both core and headline CPI, and the trend is undoubtedly lower. If you remember our 2023 outlook, we talked about three things: continued volatility, moderating inflation at a bear market bottom. That middle one, moving from inflation with a 9 handle on it, 9.1% down to where we are today, is pretty meaningful movement. The Fed's actual preferred measure of inflation, PCE, you see very similar kind of facts and figures. Now, we're not at the proverbial target of 2%, which is what the Fed would like to see, but we're moving well in that direction. And then finally, the market's view of inflation. Frankly, the market has been fairly sanguine on inflation and its persistence. Rather, not to use a dirty word here, but transitory is probably how the market has been thinking about inflation, even though the Fed really got caught and stuck on that word. And so this is 10-year and 5-year break-even inflation rates. So this is the market's expectations of forward inflation. And you can see even when we had, June of 2022, when we had inflation in the 9% range, inflation's expectations went up to 3.5, or on a 10-year basis went to close to 3. That's a pretty benign inflationary environment. So the market has been anchored there and really hasn't moved. Now, what I would say the market has moved on is this higher for longer expectation. So this is a bit of an eye chart. So stick with us for a second. We'll explain the chart and then give you the context around it. So one of the tools that we have at our disposal to get a sense of expectations for the Fed and Fed rates by the market is futures. So we can look at futures to show a probability distribution of what markets are saying. Hey, this is what we think is most likely. And clearly markets don't always agree. And so there's a distribution around that outcome. Now, this whole chart is the market's best guess for what the Fed funds rate would be in July of 2024. So just call it next summer. Now, these distribution columns are as of different dates. So this is what did the market think the Fed was going to, interest rates would look like at the end of last year. So call it 12/30 last year. And then we roll that forward to 3/31, 6/30, and 9/30. And you can pretty clearly see, the market said, hey, look, going forward 18 months, this is still when we were very much in the recession as a certainty camp. The general expectation was, rates would be somewhere in the 375 to 400 range. If you look at even as of March 30th, there was only, call it a quarter or so, chance that rates would be above 375. Now we get into this higher for longer conversation, and that distribution has moved way down. And again, this is for next summer. So, the middle of this distribution here as of the end of September, is still sitting at 500 to 525. So only 25 basis points lower than where we are today. And then it's kind of split, right? It's a bit of a flip of a coin on is it going to be lower or higher? But the fact that this distribution has even moved to where we are today relative to being anchored to this notion of cuts is a difference, very much so in what we've seen over the years. So the Fed has been effective to move expectations on this kind of higher for longer narrative. And that's influenced prices. We've seen that change. Rob talked about the long end of the yield curve. We've seen that change in current yields. And so that's what we're going to dive into in just a minute here and talk about what that means for potential outcomes going forward. And on the fixed income side, how it's far more attractive today than it has been in quite some time.
Great. So the yield move, as you can see on the left-hand side or the leftmost column, right, that 929 column, yields are now kind of almost at parity between various duration tenures, right? You've got cash, call it that 1 to 3 month yield at 5.4. You've got intermediate yields 5.2 to 5.4, and you've got the Gov Credit Long Index at 5.5. And most of that rate increase over the last year has been driven by interest rates, as we've talked about, and right, credit spreads have remained tight. So most of that move is interest rate driven, but the opportunity set for that intermediate part of the curve looks much more attractive than it did, call it 1-2 years ago when rates were essentially at zero. We've talked about the Fed pause and this higher for longer environment. And what does that mean for kind of forward returns of various fixed income asset classes? And what we did on the bottom is we took, the date of their last Fed rate hike, and we looked at what happens to the fixed income world, for the next 3 years after that last hike. And you can see, the Bloomberg Ag, that longer duration, intermediate duration area of the market has performed really well, right? Typically, if you're at a rate peak, the next direction would be lower, right? So getting that benefit of having high quality duration exposure compared to, call it cash with no duration, or a quarter of a year, a half a year, still positive returns, but that reinvestment risk, getting higher and higher as rates go down and down, tends to lag kind of that longer duration aspect. And I don't think we would advocate going to the 30-year part of the curve and adding duration to portfolios, but being thoughtful about building a resilient portfolio, thinking about that intermediate high quality portion of the fixed income curve might make sense as we move into the back at or last few months of the year and think about how we're building resilient portfolios. And if we think about that new attractive or more attractive environment for fixed income, and we weigh that against the equity portion of the portfolio, the relative valuation gap between fixed income and equities has compressed significantly. What we have is the earnings yield, so the inverse of PE for the S&P 500 versus the yield to worst for the Bloomberg aggregate. You can see that we've basically converged to almost parity. The base, we're talking 10-20 basis points of difference at this point for the first time since 2002. So over the last 20 years, from a yield perspective, fixed income has looked a lot worse, and that's primarily driven by the lower interest rate environment in that kind of post GFC and post COVID world. But you can see just the recent spike up in interest rates and yields over the last year and a half have driven those valuation gaps much closer.
And I would just mention here, maybe as we again look to 2024 and beyond, this is look, the shape of this move for the yield of the Bloomberg aggregate is profound. If you rewind the clock and you're an investor that's trying to get let's just call it a 7% rate of return, and it's 2019, 2020, early 21, you really have absolutely no chance of getting anywhere near that target with a material amount of investment grade fixed income. It was yielding 110, 150. Those are very punitive yields. Our outlook for 2023 was goodbye Tina. There is no alternative. As this has shifted and valuations have been, becoming more full in equity markets, that relative valuation is starkly different. And so again, taking that, I'm trying to get a 7% rate of return, and I can get a lot of the way there, 5.5, 6 with just fixed income, which obviously has a much lower risk than equity. That's a conversation that's important to have, and one that we'll be highlighting and discussing as we talk, really at our 2024 outlook, as we release, our content, call it, in 6 weeks or so, the prudency of that discussion, and the ability to target those returns without material risk or being forced into owning, a lot more risk in the portfolio. Those are important conversations for our clients to have. Now, as we, move into the question kind of portion here, I know we've gotten a couple of questions along the way. We've tried to answer those as we go. So obviously, if we don't get to any of them, feel free to reach out to us after. But, one of the things we often see is just kind of this, well, what about, and then you fill in the blank. What about bank failures? What about China-US relations? What about the debt downgrade or earnings, right? There's no shortage of things to worry about. One of the things that falls outside of the quarter, but we do want to bring up because it happened just very recently, was, the recent geopolitical conflict in the Middle East with Hamas invading Israel or attacking Israel. From a humanitarian perspective, clearly a horrible event. Really for anyone impacted by that, our thoughts and prayers are with those individuals. But from just a markets and economics view, the number one risk there, as we see it, is mostly around oil. Oil is the number one export from the Middle East. In a skirmish or even a war between Hamas and Israel, just them has fairly low impact. Perhaps in oil markets or even in economics across the globe. Now, to the degree that expands, if Iran is to be found supporting, Hamas or Hezbollah, Iran produces almost 4 million barrels a day of oil, and we have a fairly tight oil supply. One thing we could say is the price that everyone knows around the world is the price of gas, right? So as gasoline prices go up, inflation goes up, investors, are more and more upset. Perhaps multiples come down. So that's something that we'll monitor. But we would say, while that is a horrible humanitarian event, much like Russia's invasion of Ukraine, the net economic and market output is fairly limited, although be it we will continue to watch, the potential impact or perhaps expansion should that take place. So I know we're at the top of the hour here, and as I'm scrolling through the questions, I think we've hit all of them. So first off, we appreciate you dialing in. Secondly, as we think about, as we move towards the end of the year here, you can expect a couple of things from us. So we will be moving into the capital markets update in 2024 outlook. So the next time we get together, we'll be talking very explicitly about what do we think about 2024, how should you be updating your portfolios, and the key opportunities and risks that are enveloped in each of those. So look for that information forthcoming. If you have any questions in the meantime, feel free to reach out. Otherwise, thanks for joining us, and we appreciate your time. Bye, everyone.